Here's how to start an investment portfolio from scratch and get yourself invested in the easiest way possible. Now, investment portfolio simply just means what you're invested in. It could be one stock, or it could be multiple asset classes, whether that's stocks, funds, commodities, crypto, real estate. Whatever it is, investing is very personal, and what might be right for someone else could be completely wrong for you. It's important to note that more complex doesn't always equal better. It actually becomes harder to manage, and you'll have to commit more time to it. So let's get into it. So first thing we need to do is define our goals and our timeline. So what are we actually saving for? Is it for retirement, buying a home, growing wealth? We need to really define what specifically are we saving this for, and then what is our timeline. So say, for example, we're looking to buy a house. Is that in the next 2 years? Is it in the next 10 years? That's really important when it comes to making your investment decisions, is knowing how long you want to be in the market for and what is your time horizon. Maybe you have multiple goals. Maybe you have some short-term goals and some long-term goals. So it's important to split those out as well. What's your risk tolerance? Are you comfortable with risk, or would you prefer playing it safe? How would you feel if you looked at your investment and it was down, say, 20% from where you invested? Even though that loss is just on paper, how would that make you feel? Would you be tempted to sell that investment to, cut your losses? Or would your mindset be, oh, I can invest more at a lower price? With longer term goals, it allows you to ride out volatility in the market. The longer you can stay in the market, the less likely that your portfolio overall is going to be down. Next is about understanding the basics of diversification. So this is about not putting all our eggs in one basket. We can split this into multiple levels, starting with asset class. So we will look at 3 major asset classes in stocks, bonds, and cash. Now, stocks are going to give you one of the highest returns, but they're also going to come with the highest risk. Bonds are going to give you a lower return, but slightly less volatility and slightly less risk that comes with it. Cash is going to give you the lowest return out of the 3, but it's also going to give you some stability and the ability to react to opportunities. I'm going to focus a bit more specifically on the stock part of that asset class, because I imagine that's where most people watching this video will be more interested in putting their money. So then we can look at diversification within that asset class. What does that look like? So are we going into investing in different companies in different regions, in different sectors? Or do we want to simply invest into an index fund? So an index fund is simply a tracker of a specific market. So you could invest into a global index fund that's going to give you exposure to obviously the global markets. You could be more specific, whether you want to invest specifically in the UK market, in the FTSE 100, or potentially you want exposure to the American market and you'd be investing in the S&P 500. These vehicles make it really simple to invest. They're very cheap to invest in. You get exposure to multiple companies in different sectors. You don't have to worry about rebalancing the fund, and you can just track the returns of the stock market. You could have a bit of a split approach where you invest the majority into an index fund. So say you want to invest into a global index fund, you just want to have a really simple approach of getting exposure to the global stock market, but maybe 20% of your portfolio you want to just dabble in a few single stocks. And as long as you're comfortable with doing that, then that's absolutely fine. Next, it's important to choose the right investment accounts. So especially if we're saving for the long term, we want to make sure we're in a vehicle that's going to be tax efficient. Now, this is going to be different for different countries. In the UK, we're talking about an ISA, so that's an individual savings account that is exempt from capital gains tax, any dividend, income tax, any returns that you're going to get within that fund are exempt from essentially all taxes. In the US, it'll be utilizing something like a Roth IRA. You want to make sure it's easy access, so there's no lockup periods. You can easily access your money. If there was an emergency, you needed to withdraw it, make sure you know what the withdrawal process is. Make sure there's an easy option to be able to invest regularly. So if you're especially investing for the long term, make sure it's got a regular deposit function that you can automate, have a very hands-off approach. Make sure you're able to adjust it very easily. Even better if it's got a function where you can invest, say, monthly automatically, and you can split where that money goes, and make sure there's no hidden costs on top of the fund. So when you invest in a fund, whether it's an index fund or an active fund, you don't actually see the fee that the fund takes. It's a mutual fund, so it's grouped every investor's money together from a pot, and that fee is stripped from it. So when you see the performance data, that's already had that fee taken from it. But some platforms will charge a fee on top of that, and that's going to differ from different platforms. So just make sure you're aware specifically of what you're paying. A big part of this is building a good habit. So what I mean by that is start small and stay consistent. So just because you can only invest, say, £50 per month, whatever it is, it doesn't really matter what the figure is to start with. The most important thing is starting. The longer time you can spend in the market, the better you're going to be, and the more you're going to be able to ride out volatility because you're investing for a longer period of time. Don't wait to have a perfect amount that you want to invest. Just start. That's the main thing. Following on from the previous point about making sure it's got an option to be able to invest regularly, that's really, really important. So this is utilizing a concept also known as dollar cost averaging. And all this means is, say you're investing monthly. Well, that means that, say a stock comes down down, on paper, it might look like an unrealized loss, but because you're investing monthly, what it means is that you're actually going to be buying in at a lower price. So it means you're going to be able to capture a lower price, thereby reducing your average buy price. So in the long run, that's actually better. Where if you just put a lump sum in, say at the start of the year, and then the market went down, where you've already put all your money in, where if you have more of a regular investment, then that's even better. Some platforms will allow you to invest more regularly, so it doesn't necessarily need to be monthly. It could be weekly, bi-weekly, even daily. Having a more hands-off approach means you're less likely to touch it. So we're not looking to be speculative or trying to beat the market here. There's very few professional fund managers that actually beat the stock market in the long run. So say, for example, you invested into a global stock index. Well, there's no need for you to check that every week, even every month. I would say 6 to 12 months, you want to just be assessing what you're invested in. And it's not even assessing what you're specifically invested in. It's more about going back to your timelines and your goals, making sure what you're invested in still aligns with those goals and timelines. Have they changed at all? Is anything else in your life that you need to change your investment approach, essentially? And not checking it as often, you're also going to avoid reacting to market swings. So similar to what we just said about having that regular investment approach, say every month, where you can capture down swings, you don't want to get into the habit of checking it daily and reacting to those daily changes, because that will really freak you out. You're going to make some bad decisions if you do that, and you're going to drive yourself insane. So to sum it up, set your goals, diversify, choose the right accounts, and stay consistent. The sooner you start, the better your financial future will look. If you found this useful, like and subscribe for more investing tips, and share this with someone who's just getting started. Thanks for watching, guys. I'll catch you in the next one.